Hello there. Okay, so welcome to the Stock and Profit Trading Basics course, Chapter 3. Today we're going to be going through the introduction to technical analysis. Now, as you would have, of course, observed all through this particular course, this is just the basics, and this is to build a foundation of what you would need, to go into trading as a professional. So, the Stock and Profit Trading Mastery course, which is the second course in the series, it's the course where we're going to begin to break down. I'm going to be showing you, the stock and profit strategy and how to use that in the market. But for today, we're just going to be looking at the basics, what is technical analysis and some of the concepts, that make up technical analysis. So, lesson one. So first off, just a recap of this 4 stages of competence, because I feel this is something really important that any person who really wants to understand trading needs to have, at the back of their hands, or just needs to have it, up there in their head, that this is the process. This is essentially what you will go through. So you have here the 4 stages of competence. So you start from the unconscious incompetence, wrong intuition. You're just coming into trading, you don't even know what you're doing, and you may not even know that you're really incompetent. You probably have read different information, gotten different videos that have shown you different things from different places, but still, there's that unconscious incompetence. So your intuition is wrong. You don't know what direction the market is going to go. You're just guessing. And then from there, you move to stage 2, which is conscious incompetence. Now you know that you don't know. You've tried, you've done a lot of trial and error, and you've seen that, hey, I don't even know where this market is going to go to. I'm just predicting. I'm just, assuming things in my head. So you know that your analysis is wrong, okay? But you're aware and you're conscious of your incompetence. And then after that, with practice, you're growing, you're doing all of the practice, you're learning just the way you're doing right now. Then you move to stage 3, which is the conscious competence. Okay, now you begin to understand how the market works. Your analysis is correct. You're just following what the market is offering you. So you're not scared. You know what you're doing. You're consciously competent now because you understand the concepts, you understand structure, you understand liquidity, you understand inducement, you understand, different things about the market. So your intuition really, or your analysis, at this point in time is now right. And then the last step is the unconscious competence. Now, this is the level of mastery. Okay, this is the level where you're not thinking about it, but you just know you're right because now you have a lot of experience, based on the time and dedication you've given to the market. So you know where the market is going, you know what price is going to do. You're unconsciously competent. It's just like, let's say for example, you pick up a spoon, you're trying to eat food, your hands already know where your mouth is. Okay, you don't have to teach your hands like a baby would try and struggle and struggle and struggle to take that spoon, to put the food in your mouth. You don't have to do that because you're unconsciously competent already. You know it. Your hands, there's the muscle memory. So your hands already know that if I pick up this food, it goes straight into my mouth. I don't put it into my nose, my ears, my eyes, my forehead, my jaw, my chin. No, it goes straight into my mouth. Okay, now that is unconscious competence. And that's what happens to traders after you've put in the work. It takes sometimes 1, 2, 3, 4, 5 years of mastery for you to go from ignorance to mastery. And this is something you must have at the back of your mind, okay, or at the back of your palm, as they say. So this is very important because if you have this, you understand that with time your performance is going to continue to skyrocket and you become better at trading. All right, so that said, let's proceed. Now, what is technical analysis? Now, technical analysis is simply the study of historical price action in order to identify patterns and determine probabilities of future movements in the market. It is basically a framework deployed by traders to understand the market. Okay, so you're looking at historical price action. You open the chart up and you're looking at what is the historical price action, and then when you look at that data, based on that data you develop patterns, okay, and those patterns will likely repeat themselves over and over and over again, and that is simply what you just take and you deploy that into the market. You go into the market and you're looking for those patterns and you're just trading those patterns. Now there are many things of course associated with that, so not just the price action patterns. some people use indicators, to be able to tell them, okay, where you have when they should enter a trade, where they have different concepts, imbalances, and so much more. So, but technical analysis is just simply at the basic level, you're looking at historical price action, and based on that historical price action, you develop patterns that you'd always look out for in the market, and then you trade them. Now, at Paruto Capital, we deploy, technical analysis as a framework to bring about order and methodology to the chaos and noise of the market. So, for anyone who is just coming to the market, when you look at the chart, it's a lot of noise. Really, you can't really tell what is happening here, what is happening there. Okay, for a newbie, but when you use technical analysis, it's simply just a way for you to bring order, and just reduce the noise in some shape or form, and bring methodology into the chaos and noise that the market presents. Now, we study price action purely using proven and tested tools, which you would learn soon. Okay, you would learn this in the course. In this basics course, we're going to be touching just a few concepts like structure, but in the mastery course, we'll go in depth. We're going to be looking at liquidity, we're going to be looking at inducement, and so many other things, time, sessions that help you to make informed decision as a trader. Okay, now continuing with the introduction technical analysis. Now, the bare minimum, my technical analysis mantra is this: that price action is king. Okay, now a lot of traders use indicators and use so many other things, to trade, but at the end of the day, whatever you see on the chart is simply just price. Okay, so price action is king, irrespective of the indicators you're using, irrespective of the boss or whatever you're using. If you understand price action, then you will make it long term in the market. And then market structure is also king. Okay, so when we talk about patterns, those patterns are not isolated. Okay, we look at the patterns in context of the market structure and also price action. Okay, so it's very important to understand and to always remember this. Now, the main evidence for using technical analysis is that theoretically all current market information is reflected in price. So whatever it is you're analyzing the market is simply reflected in price. The price, what the market is showing you, that's just what it is. Okay, so if price reflects all the information that is out there, then price action, it's all one would really need to make a trade. Okay, now technical analysis looks at the rhythm, the flow, and trends in price action. Now, patience, discipline, and preparation will set you apart from traders who simply trade on the fly without any preparation or analysis. Okay, this is something you need to remember going forward. Now, what are some terminologies that you need to understand when we talk about technical analysis? One, break of structure. We're going to see that on the chart. Well, break of structure simply means that the previous structure that was formed in the market either gets taken out by a new structure, essentially leading to what we call a break of structure. The previous structure has been broken by the new one. Now, we also have what we call inducement. Inducement also is a structural price action creation, where essentially the market kind of tricks new traders or beginner traders to take a trade from that level, not knowing that level, maybe a low or a high, is simply an inducement to the demand or the supply zone, below or above it. Okay, respectively as the case may be. Don't worry about the jargon. We're going to see this in the live market scenario, so this shouldn't be a problem. Now, there's also something called liquidity. Okay, so liquidity essentially is where the money is in the market. Okay, so you're simply looking for liquidity because that's what's going to determine what direction of trade you take. Okay, now we also have the supply and the demand, and the strategy I'm going to be showing you in the trading mastery course is going to be heavily based on supply and demand. Okay, and we're going to break this down because this is essentially what makes technical analysis. For me, I only trade price action. I don't use indicators, and these four things: break of structure, inducement, liquidity, supply and demand, is all you need to succeed in the market. Okay, so moving on from that, let's look at the basics of market structure. Now, we have what is called the uptrend. Okay, so when you say something is trending up, that simply means the thing is going, up, right? Is bullish. Okay, some people say uptrend, some people say the market is bullish. That's simply what it is. Okay, now The bullish market structure, here we have an example. As you can see on the screen, this structure essentially here just says you have a higher high, higher low, higher high, new higher low, new higher high, new higher low, and then it continues like that. So evidently you can see the market is moving upwards, right? That is a bullish market structure. It's an uptrend. So in this market situation, you don't want to be selling because you can see clearly the market is going up. And then now we have the complex reality. Now while this one looks smooth like this, in the real market situation, it may not just be long bars just giving you highs and lows. This, it's likely what you may see. So you have higher high, higher low, higher high, then you have a lot of minor structure inside, then leading to another higher high, minor structure inside, low high, and all of those things happening, and then leading to another higher high. For now, this is not the place where I'm going to be explaining what those inner structure means. For now, you just understand the concept of uptrend simply means bullish market structure. Now, downtrend is the flip of what we just looked at. Okay, so it's called also the bearish market structure. So with the flip, you have lower high, as you can see here, leading to a lower low, lower high leading to another lower low, lower high leading to another lower low. What this simply does, or what this simply means, is that price action basically just continues to dip. Okay, it's a bearish order flow, it's a bearish market situation. That is simply what we have here on the screen. And we have something here that's more that looks like what price is going to do, because the price is not just moving a straight line. It's always a zigzag motion eventually until it takes out the previous high or the previous low, depending on where liquidity is. Now let's look at the concept of BOS, that's breaker structure, strong, weak highs or lows. So let's look at that. Just a second. Okay, now this uptrend bullish market structure, let's look at what we have. So you can see here that the full this arc here created below here simply referred to a strong low. And why is it a strong low? It's simply because this low led to this previous high being taken out. That makes this a strong low. The same also here, this becomes a strong low when price takes out the previous high, and the same happens here when price takes out the previous high, it becomes strong low. Now all of these highs that you have here, all of these arcs that you have here that dotted, simply says that those points are weak zones, as it were, or weak supply zones, simply because they fail to take out the previous low, so they become weak essentially. And this is what you're going to be seeing all through the program. Now here we also have something that looks more likely than what's going to happen. So it's not just going to be a straight line. You may have a lot of zigzag until price takes out the previous high. So that's the concept of the strong, weak highs and lows. Now for downtrend, you just need to flip the same thing. Okay, and you see here that you have the higher high. When that takes out the previous low, that becomes a strong unprotected zone, while the area that failed to take out anything becomes a weak zone. And that's what you see all over this place essentially. And this is the concept of strong lows, strong highs, or weak lows and weak highs. Okay, so that essentially it, as simple as that. Now look at this structure that we have here, or this drawing rather. You can see that this is what do you consider this? If you said weak, that's awesome. You just clap for yourself. Okay, that's beautiful. And then what do you say to this? Is this a strong or weak low? Yeah, so strong low. I want to believe you got it. So if you did, you completely understand the concept. So you can see all of the lows that took out the previous highs are considered strong, and all of the highs that failed to take out a low are considered weak. So high, weak, and low. And you can see that all over the place. This is now a strong because it took out this guy, but this also becomes a strong when it takes out the previous level. And the same thing, feels strong, high, low, and then this one takes out this becomes a strong low, and then it plays out like that. And that is essentially how we identify structure in the market. The reason is simply because if you see that structure is bullish, it would not be in your best interest to begin to sell. Okay, you should always trade in direction of the trend. As they say, the trend is your friend, so embrace it and do just that. Now, still on the ball, strong, weak, and high, highs and lows, you can see a typical structure showing the same thing: strong, low, strong, low, strong, low, strong, low, strong, low, because I was taking out the previous low, and then another strong low because it's taking out this guy here. So there are places, of course, where you may have, a lot of cross in this as you continue to study this, but the basic thing you just need to understand is strong lows, high lows, weak lows, weak highs, and that was probably be helpful. All right, now let's look at the concept of supply and demand. Supply simply means a selling zone. Okay, demand simply means a buying zone. When there is demand, when price comes to demand, people want to buy to go into the bullish direction. And then when you talk about supply, people want to sell for price to now sell off and go in the bearish direction. Now, a similar concept to this is support and resistance. As a matter of fact, most times you can view it as support and resistance. So where you have, a line basically serving as resistance, that could be the supply, and when you have a support, a line serving as support, that could be the demand and all. So that's essentially the concept. Now, it's important to understand that supply and demand is the driving force behind changes in price. When there are more sellers than buyers, the market will move down, and when there are more buyers than sellers, the market will move up. Okay, that's simply the concept. Now, when buyers and sellers are more or less even, the market will range. So nobody's the buyers and the sellers are all trying to do the same thing on the opposite sides of the currency. It will just remain there. It wouldn't really move everywhere. Now, when there are more sellers than buyers, the market will move down, and when there are more buyers than sellers, the market will move up. Okay, now when buyers and sellers are more or less even, the market will range. Okay, and that's where you begin to see in the market that price is just ranging. It's neither going up, neither going down. Okay, now that said, the supply and demand basics, using an orange to explain that. When you have demand, that simply means a lot of buys are coming in and people want to buy from that demand level. Okay, now when you have a lot of sellers, will usually be where maybe the goods in the market has really improved, and then they're selling off directly from there. Okay, now just a sec. In the financial markets, the asset is a product, and the rate value is the demand. Okay, so if the price is cheap, it means there's more supply than there are willing buyers. If the product, is getting expensive, that means there are more demand buyers for less supply. Okay, now supply and demand basics. So look at this: the buyers versus sellers. So when you supply, you're simply just selling, okay, at a premium, and when you buy, you're simply just buying, at a discount. That's simply the dynamics between supply and demand. Okay, now, the theory of supply and demand forex trading is based on analyzing and defining zones in the past. These zones determine where should we expect price to react to in the future. Okay, and that's how that is drawn. Now, drawing your supply and demand zones, you can see here in the market, we have here, this becomes a demand because it took out this high, and then over here we have this area here taking out this, making this a supply. The same thing, this took out this, making this a supply zone. Price returned to it, tapped into the supply zone, and started selling off again and again and again. And that is essentially just an illustration of your supply and your demand zones. You buy from your demand zones, you sell from your supply zone, and that's how it goes. So now we're going to set up TradingView and practical chart walkthrough on various market concepts that you need to know. Okay, so let's do this. Just a sec. I have to open this here. TradingView. Okay, so let's do this JPY. Okay, so first off, if you don't have TradingView, I'll encourage you that you just go to tradingview.com and just do what I did, and you'll be able to access TradingView. You can also use the link I believe in the description section, to also open your own version of TradingView. So this is a paid version. So for you, you may not have all of these things, but essentially you'll be able to do all that you need to do in the market. Okay. All right, so welcome to this is just a continuation of chapter 2. So we'll look at a few things. So just by way of recap, so supply and demand basics. We did mention, or I did mention, that when you talk about supply, you simply mean sellers, okay? A zone where you sell from. In other parlance, you can regard supply zone as resistance zones. For those of you who are familiar with trading, so supply zone is simply just an area of resistance, okay, where sales happen. And then you have your demand zones where buyers demand to buy, okay, and they buy usually at a discount. So if, for example, you have a store that's trying to sell something at a very cheap price, you're going to have a lot of demand. And if it's, the price is high, it's premium, then a lot of sellers want to sell at the premium price, because that's where they make their profit. And then you have, of course, a lot of supply when the price is really high. So for example, let's say you have a situation where maybe food is scarce, okay, or grains is scarce. What's going to happen is that if you have suppliers who already probably stocked all of that for a period of time, they would be in abundance. They will want to sell if the price goes up. The supplies basically will be in charge of the market. So that's just the concept. But now, in terms of trading, this is just a lot of jargon. We want to look at something very practical that can really help you just nip this in the bud, so you understand supply and demand zone. So what I'm going to be doing is I'm going to be going to TradingView, and in TradingView I'm going to be showing you a lot of demand, supply, and we're just going to see how all of that can be put together in the live trading environment. So let's start with, I have here various charts on my screen, but let's start with, say, something like AUD. Okay, so now there's a lot of information on this chart, but let's see. Let me start from the 4-hour. So now the 4-hour, this is a 4-hour chart. By the way, if you haven't set this up, setting your TradingView up is quite easy and simple, but this is not what I'm going to show you how to set it up. This is just for me to show you supply and demand. I'm still going to show you how to set up your TradingView if you haven't done that, okay, in a separate video. Okay, so now we have all of this in the chart. So what I'm going to do is I'm going to take out all of the drawings that we have, so we can just okay, just have a clean chart. All right, so here we go. So now this is basically just a bunch of candles going up and down. All right, now how do we begin to scope our supply and our demand zones? Now, taking for example this area here, you can see here, if you to draw a line, you can see that this is sort of slanting downwards, right? It's dropping. So that simply tells you that the market is trending bearish. It's a bearish trending market, at least in this area. Now, when you have a bearish trending market, essentially you're going to have a lot of supply zones where you're going to be looking forward to selling from. So let's take an example. So let me start from where we had this bearish push, or where this bearish push kicked in. So here I'm going to take this and I'm going to draw this from this low here to this candle here. Now look at that. Let me take this out. Now look at that. So when I draw this low here, because why did I draw this low? This is simply because that was the low that took out this previous. This was the high, price returned here and then took out that high. So that gives us, this was the last low in terms of this structure that we have here. Now price returned and then took out that low. You can see that. Now price has returned here and then price dropped. Okay, let's just draw this. Let's just do everything. See, price dropped again. Okay, up, and then continues like that. Now, what this now gives us is this. We can now see clearly that we have, if we draw from the top, let me just take out this. Okay, so if we draw from the top, this area here, we can draw that to this candle here. Okay, what that meant is that after price took out this previous low, price returned into the supply zone. Okay, so we can name this as what do we have there? Supply zone. Okay, so we can just move that to the middle. just for the purpose of yeah, looking nice. Okay, so that's the supply zone. So price returned to the supply zone and then sold off again, essentially creating for us another new supply zone. Okay, so we can draw from the top here, or we can draw that all the way out. So that essentially becomes another new supply zone, and that's how we can continue to draw all of this. So we take the next low that was taken out. Okay, and then where is the high for that area? This was the high that took out this previous low, so we draw that out. You can see here very small supply zone, but it's there. You can see that price took out this low, made a new low, returned into the supply zone and sold off again. Okay, and then we can continue to do this over and over and over and over again. So we can also draw this out. Now, how do you draw this? A lot of time, sometimes you may just draw it from maybe the last candle up, or sometimes you may just draw it if you have a structure that has already played out, just to get a sense of what price reacted from. So we can just draw something like this, not necessarily just a candle. Okay, so we can just draw something like that. I hope you get the gist. So that is essentially it. So, but this is a supply zone. Now, when you have a supply zone like this one above here, that is not that no candle or price did not mitigate. Now, I just hope this is not a lot of jargon for you. But you're going to be hearing a lot of that, that price mitigated the zone, price is yet to mitigate the zone. That's just something you need to get used to. So for this supply zone, for example, you can see the price did not return all the way up. In other words, price is yet to mitigate the supply zone. But at some point in the future, price would have to mitigate that supply zone. Okay, so for this one, for example, we can't say price has mitigated the supply zone because it's played out. So we dragged, the entire supply zone, not just on the candle here, but we dragged it, all the way to where price, mitigated that supply zone. So you can have mitigated. So basically, you can have mitigated supply zones and unmitigated supply zones. Okay, so we can say mitigated in this instance, supply zone, and then also we can have unmitigated supply zones. Okay, so unmitigated supply zone. Okay, so we can just have that. So that's just a concept for you to learn. So we can continue to do this over and over again. Now you can see here price has returned to this at this level here, tapped in, sort of took that out, and now price is dropping. So this happens over and over and over again. And if we even to look internally here, let's see what happened here. So here you can see that price created a low here and then eventually took out the low, and then creating for us a new supply zone. Can you see that? We draw that out and you can see price essentially returned, tapped that, and then started selling off. And you can have supply zones literally everywhere. Okay, now for this one, this becomes the high, but you can see price came there, swept the high, tapped into this previous unmitigated supply zone before dropping. We're going to look at this more in the technical in the mastery course, why sometimes price may react from some zones and some other times price may not react from some zones. So we'll look at that. But I want to believe you're beginning to get a hang of supply zones. Okay, so in a bearish trending market, all the areas where price returns to, taps or mitigates those zones, and then sells from, those are essentially our supply zones. Okay, in a bearish trending market. Okay, so we can take another pair. Let's take another pair, not a random pair. Let's take let's say what now? Let's take EJ, right? Euro JPY. So let's take that for example. So this is the 4-hour chart. So for EJ, you can see it has been bullish from around since 2023. Dropped in 2024 from like July, and then now it's sort of ranging. It's literally nowhere. No man's land, as it were. So let's look for maybe a period of time where it was selling off. Do we have that? Can we get that? Okay, because we want to look at supply zones. Cool. So here we have a few. So here you can see, just by looking at this chart here, we can draw from this low here to this, and then we draw the highest point, giving us a supply zone. The price eventually mitigated at some point and then sold off, right? So we can do that over and over again. We can just continue to look for this. So one of the assignments I'm going to give you is Identify as many supply zones as you can, in the market. Just pick a random pair. By the way, you can see how I arrange my pairs. So you can just pick a random pair. Arrange your pairs this way. So you have, for example, USD pairs, JPY pairs, Swiss pairs, card pairs. So just arrange them this way. And then just pick any of the pairs. Identify at least, let's say, 10 supply zones, and then upload that in the comment section. All right. Or maybe even the quiz, so you can just upload that, so that this is really something that you sort of understand, okay, just by going through the market and identifying all the supply zones. So we can draw that high, that's also a supply zone. Okay, so like I mentioned, your supply zone can just be maybe the last candle up, or it can just be an entire zone. All depends, on the market structure at any point in time. But we're going to be looking at that in depth in the trading mastery course. So that is that for how you identify supply zone. Let's take another pair. Let's take something like Bitcoin. Okay, so for Bitcoin, well, Bitcoin is not the best pair to look into, because Bitcoin basically has been going up like forever, right? So but we can actually look at a few. So look at this, for example. Let's look at this area. I can see this. Okay, so draw the slow to this guy here, and then the highest point there, you can draw that out. You can see that's a supply zone. So after price created the low, price eventually returned to that area, mitigated it, and then sold off again. All right, so we can also do the same for the low that was created and draw that out, and then we can also draw from the highest point there. Okay, you can see price returned, mitigated that supply zone, and then dropped again. Yeah, you can see that clearly. So that is essentially it. Okay, so this is basically how you just identify your supply zone. Just look at a bearish trending market, and then you see that all the highest points essentially become your supply zone after a break of structure. So if we're to draw this using this tool, so we can have high, low, can just draw the entire of this, and then high, and then low, and then return supply zone, and then low. I hope this makes sense. So you can see that is essentially our supply zone mitigation. Okay, so structure mitigating the previous supply that was created. Okay, so that is that on supply zones. Now let's look at demand zones on the other hand. So let's look at gold. So let's go to the 4-hour for gold. That's what we have. Now for gold, let's look at demand zones. I already have a few mapped out. So like I said, you also just need to do some assignment. So pick any pair of your choosing and just map out, the demand zones. Okay, so for gold, for example, you can see here, let's just see, we have here this high break of structure. The exchange created now creates a demand zone. Okay, and then you can also look at the internal price action, and you also have demand zones that have been created. So look at this area here. You see this high was also taken out by this candle here, creating for us a demand zone, and that demand zone after this high was taken out is yet to be mitigated. Okay, so we can draw all of that out like that. Okay, so you can keep doing this again and again and again. Let's look at this one here. So here you can also see that we had break of structure creating for us a demand zone. You can actually just take this out and just draw from this candle to this. So price return, mitigated it, and then pushed higher, and then creating for us a new demand zone. Price after this break returned, mitigated it, and is pushing higher, creating for us another new demand zone, and then so it goes on and on. Basically, you can see that demand zones created after every break of structure. Okay, so demand zone, another one here, you see that? So all of them, they are all unmitigated, at least for gold, and at some points in time, hopefully price will return and mitigate some of this demand zone. So gold at this point in time is actually registered its all-time high at the time of this recording, which is really nice. But that is just it. So let's look at another pair. Okay, let's take, since we have this here, USD card. So let's look at the USD card. So here you can see this is the 4-hour, so we may not see so much in terms of price action, though we've seen a lower time frame, but just to show you what the demand zone is. So here, a bullish market break of structure, creating for us a demand zone that is yet to be mitigated. You can draw it all the way this here, but anyways, you get the gist. So demand zone there, break of structure, another demand zone created here, price returned to it, and mitigated that. Break of structure here, we have another demand zone. It's still unmitigated, so we can leave that where it is. And then it goes on and on and on and on and on. So as usual, identify this in your own chart and submit as part of your put in the comment section, and also you can submit as part of your assessment. But that is essentially your demand and your supply zone. Okay, so I want to believe with this you have a pretty much good understanding of the concept of demand and supply, and it's not something really foreign in the market. It's easy for you to now look at the market and you can easily see, okay, we have a demand here, we have a supply here, so it's easy for you to really see this. But let me also show you in the 15 minutes some of these concepts. So you can see here, excuse me, some of this withdrawn from the walkthrough we just had a few seconds ago. Okay, so here you can see a lot of so clearly you can see here, number one, the first thing to identify, the market is bullish. So with the market bullish, that simply means you're going to have a lot of demand zones. And what do these demand zones signify? It's simple. With the demand zones, or with a demand zone, you're simply just waiting for price to return to the demand zone, and then you look for an entry to continue to go bullish or to continue to go long. Okay, for supply zone, you're waiting for price to arrive at the supply zone, mitigate the supply zone, and then you look for short continuation or to go short or to sell. Okay, so that's the same thing here. So you can see for gold, a lot of opportunity presented itself, because it was a bullish market, and then we had a lot of demand zones. Price return to the demand zone, you buy, create another demand zone, price return to the demand zone, and then it continues like that. You buy, and then you continue, create another demand zone, price returns to demand zone, mitigates it, and then you buy. So you just continue to see this happen over and over and over again. So price returns to the demand zone, taps into it, and then you buy, and then it continues over and over again until maybe demand zone fails and all. So but that's just the concept of supply and demand zones. And we're going to piece everything together in the trading mastery course. So ladies and gentlemen, with this, I want to believe you have an understanding of at least the basic concepts of trading. When we talk about demand, when we talk about supply zone, like I also mentioned, some of the persons refer to demand and supply zones as your supply zone is your resistance and your demand zone is your support. You buy from your support, you sell from your resistance, and that's just another version of it. Okay, so now the next trading concepts we're going to be looking at in the next course, the trading mastery course, we're going to be looking at the concept of inducement, liquidity, and advanced market structure. I don't want to bug you with that in the basics, because this basics course is assumed to be for beginners, those who are not too familiar with trading. And yeah, so we're not going into the deep technical concept. We're going to be looking at that in the trading mastery course. So I want to believe you've picked something from this, and I look forward to sharing more with you in the trading mastery course. For your setting up of your trading view, please just go to Google. You can just go to Google, search for trading view, and you will be able to just set it up. Hopefully I'll just do an extra video and attach it somewhere here in the lesson, just so that you can just easily set it up. Just register, open your trading view. You don't have to pay for now until you become profitable. Then you can decide to begin to pay for the service, but you can use a free platform to begin to test and to begin to learn all you need to learn. All right, so see you in the trading mastery course. I wish you all the best and stay stuck in profit. Bye bye.